Well, joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. 92 to 90% compliance. Are we just splitting hairs over this?
It's just absolutely amazing. We see oil fall down again. And, fundamentally speaking, I continue to say that I do think from a top-down approach, we're going to see draws coming soon. And I think the fundamentals will change for oil. I mean, right now I have a lot of egg on my face because the market continues to fall no matter how much bad news continues to come out. But I do believe that the end is near. And I do believe we will bounce back no matter just given the fact that we have on a top-down approach a 3% global GDP. That's going to help quite a bit. And also we're seeing a lot of compliance from OPEC nations.
So if you are remaining bullish on the oil space, I mean, what sort of time frame are we looking to here, Larry, that you're able to, keep the faith alive?
Yeah, exactly. I continue to maintain that we're going to see Brent at around $57 a barrel by year end. And WTI would be a couple dollars under that, and really solely based on a top-down approach that we will see 3% GDP, and by extension, that's going to create more demand for oil. And I do think we'll start to see some draws coming in the summer. So my projection is a little bit lower than it was before, but I do maintain a bullish stance, and I continue to be long most energy products here around the world.
Well, just with that in mind, in fact, I did want to get your take on iron ore. In fact, you've suggested in your research note that we're seeing iron ore really past that first sort of leg of downward pricing. Where to from here? Do you see some sort of sideways trading from here or yet further downside?
Yeah, and I don't want to be glib about saying that. I mean, it's obvious people like myself who happen to have long positions in iron ore, it doesn't feel good when somebody tells you, well, the first is over or the worst is over. But I do believe we're going to be in one of those consolidation modes. I am lowering my average target in the U.S. down to about $75 a ton. But right now, supplies are still high at port. They're still high with the mills. We've seen a lot, supply taking advantage of the high price going into right now. But I do think volatility will take over, or the lack thereof, and we'll see a slow march upwards. But it's going to be very, very painful.
I also wanted to touch on another product sort of within this commodity space, although we do know it more as a safe haven tool. Gold, in fact, this very much in focus, not only as we see this easing off in terms of geopolitical risk and concerns around that, but also as the Fed has its first day of its two-day meeting today.
Yeah, that's one of the few commodities that I've actually been right on, although I've been right on it for the wrong reasons, but nevertheless, it's definitely higher on the year. But I do believe gold's going to trip up short term, and I do believe that people have this overestimated view of what the Fed is going to do. And even if they do raise rates in June, which I think they will, it doesn't matter because I think the larger forces are going to take over. And that is, I don't think long-term rates, meaning 10-year and beyond, are going much higher than they are today. So that's, I think, what's underpinning the whole motivation for gold. And I think medium term, I do think it will trend higher. So if you want to buy gold, just wait for one of the downdrafts that we'll probably see between now and June with the Fed raising rates, et cetera, people getting excited. But I think medium term, we will see it higher.
We've talked quite a lot about the commodity space, but I just wanted to get an idea of your portfolio weighting at the moment. How are you allocating yourself?
Well, in the commodity space, I already, let the cat out of the bag that I am long energy, but I am long more of the product side, where that would be gasoline, diesel, et cetera, pretty neutral between WTI. With foreign currencies, I'm long more crosses, not really long the U.S. dollar. I still think it's overshot, and I think the better news is coming from abroad, and it will continue to do so. I am long a little bit in the agricultural space and fairly neutral right now in the precious metals, especially with gold, where I have gotten a little bit short, waiting for, to get a cheaper price to buy it back.
Larry, I'd also love to get your take on the bond space at the moment. We are seeing increasing concern, and it's been ever present since that November 8 election result, over the valuation and the priciness, as it were, of equities over their bond counterparts. How is that shaping your outlook in the near term?
Yeah, I think actually near term, medium term, the song remains the same. We're in a low growth world. We're in a world where there's a savings glut, and the combination of two, the structural changes that have not recovered since 2009, I think we're just going to have a slow march upwards, and there's going to be a real grasp for yield. So that said, I mean, I think the equity market, the multiples are much closer to the historical mean as compared to U.S. Long rates. So with that in mind, I think that story should be out the window. I mean, I think, yeah, it is true that trailing multiples are higher than historical norms, and even forward ones are higher. But that said, people are grasping for yield, and I think they will continue to do so for a very, very long time. Because I don't think yields are going up much higher than they are today anytime soon.
And it's also interesting to take this into account when we consider the global environment that we find ourselves in this week, particularly given that it is such an economically heavy data week. Globally speaking, we have GDP reads set to come out of the Eurozone area. We've got Friday's jobs number also. What are you looking to at the moment?
Well, right now it seems like the preliminary GDP data that comes out tomorrow from Europe, that's really important, and I'd like to see the momentum. We've seen a lot of good reports come out of the Eurozone. Some of them, PMIs are at 6-year highs, and the surveys are at 7-year highs, et cetera, et cetera. The FOMC two-day meeting, nobody's expecting a whole lot. I would watch any kind of language downgrade on inflation. That's a real risk to the market, because that's something that, it's the elephant in the room that nobody wants to talk about. With the jobs report, I wouldn't overemphasize it, but people are looking for a bounce back from that really bad number of 98,000 last month, and the consensus is between 165 and 190,000. And I think if it's even below consensus, it's okay, because given our full employment situation, I can't expect the economy to produce more than 150, 175,000 jobs till perpetuity.
Certainly interesting then that we will also be hearing from US Fed Chair Janet Yellen in the wake of those numbers set to come through. This perhaps really giving us a little bit more insight into, I guess, the psychology going on in the Fed at the moment. Larry Shover, we will leave it there. Thank you so much.